Welcome. My name is James Sackey. I'm the marketing director for the Vant Group and your host for the quarterly Deal Pulse, where I'm interviewing top deal makers.
So I'm a partner with Blank Rome.
So in Escor, we are a direct lender.
For their insights and their feedback.
I think on some of the sell side, you've got some companies that are in a little bit of trouble now.
On what's going on in the transaction world. Let's get to it. Thank you for joining us today. I am joined by Sanger Smith. He is founder of Decidedly Wealth Management. Sanger, thank you for joining us today. Tell us about yourself and tell us about the firm.
Yeah, man. Thanks for having me, James. So I founded Decidedly because I was a son of a business owner and a financial advisor by trade. And I noticed that business owners, so people like my dad, didn't have a lot of access to the wealth management services that the average American who saved up in his 401k had. And so I wanted to kind of address some of the problems that I see. One is not a lot of access to advice because most business owners' wealth is tied up in their business, not in their 401k or their manageable assets until they sell. The unique dealings with variability of income, managing risk, everything financially is just a little bit different. And life's a little bit different when you own a business. So I started Decidedly, and that's what we do. We work for families who own businesses and are looking forward to the transition of that business, whether it's going to get passed down to another family member, they're going to sell it, they're going to roll up an acquisition and continue working, but as an employee, whatever that transition period is. So I love doing it because I feel at home with those people. Business owners are my tribe. And I think we're just making their lives a little bit easier one day at a time.
I appreciate that. I actually learned everything I could about finance at a young age for similar reasons. My dad wasn't a business owner, but we were, subject to a lot of the things that most middle-class families are in this country. And so all of those same kinds of struggles and such. And that was why I took up finance as my vocation as well. So I definitely appreciate that. So if you're ready,
some kids learn how to work on cars.
Yeah.
That's what their dad teaches them on Saturday afternoons. My dad didn't teach me that. He taught me how stocks and bonds worked and the Federal Reserve. And so it was like that, man, that's just what I got to do.
I got sucked into it as well once I started studying it too, and I still am to this day. So for sure, we'll have to nerd out about that later on for sure. Okay, so let's jump into it. What are you seeing in deal flow right now as far as transactions? Are they increasing, decreasing, or are they flat?
Yeah, I would say like in my world, it seems like it's decreasing. That seems to be what's happening from a lot of the folks that I talk to. Certainly my clients, I guess there's a lot of reasons why we suspect that that's happening. Obviously, interest rate, this is not a new thing that interest rates have increased, but the increase in interest rates means, capital's tightened. And so when money's more expensive, we're taking fewer bets, or we're at least examining the bets we are taking a little bit more diligently. So people are finding transactions take longer because people are a lot more thorough with their analysis and are just snapping up any business that's for sale. And there's fewer buyers. So that's what I see.
Interesting for sure. And so how have behaviors changed in the last 90 days, would you say?
Yeah. And I would say when I'm talking about deals tightening, maybe more of like a trend over the last 3 years, as opposed to maybe like this quarter compared to last quarter, that's so hard to observe a trend. Behavior trend though, economic sentiment is down. And that's true with business owners. Like I think business owners, we are like generally less neurotic in overall life, but like somehow more neurotic when it comes to the economy. So, one like whiff of bad news when it comes to the economy, business owner, oh my gosh, the economy's tanking. Like I'm vulnerable now. And that's not always true, but consumer sentiment and economic outlook by the public is such a massive determining factor in the reality of the economy, because if everyone thinks the economy is bad, people don't spend. And when people don't spend, then the economy is bad. So I see that business owner like anxiety is higher. Some of that's just natural transition. You go, a new year is a new thing for me to think about, and a new president. Okay, there's change. Whether you like Trump, you don't like Trump, whenever there is change, a lot of times people kind of reevaluate their anxiety levels. So that to me seems the biggest behavioral change is an overall general negative sentiment that may not be rooted in the reality of the economic numbers, especially now that we see the GDP increase in Q2. The Q1 numbers kind of frightened a lot of business owners that I talked to.
Yeah, it's a little bit of a self-fulfilling prophecy, isn't it? There's concerns about things that probably aren't going to affect you, but then it negatively impacts your mentality around it, and thus impacts your behavior to be negative. Then, it's like you were saying with the spending part. It's like these things don't actually impact you, but it feels like they do, and then you respond accordingly.
Yeah, you're just going to invest a little bit less in R&D. You're going to maybe not stick your neck out on that new hire that you could have made. It might not even be something that you notice yourself doing, but it's there and it's real. And that does impact business, and that impacts all of us when it's in the mind of the business owner that things maybe aren't so stable anymore.
Yeah, like a lot of talks about tariffs and such, but there's not that many companies that are impacted by it unless they're in retail specifically or import exports. A lot of
For
folks are
sure.
concerned, but they don't get touched by that kind of stuff.
For sure. And I have some great friends and clients in the retail space, and they're not liking the tariffs. If you're in retail, you're getting that a lot from China. And so tariffs coming from China, yeah, that's going to hurt. But, take my world, right? As a financial services business, do tariffs impact me? Well, no, because I'm not importing anything. But I'll
Right.
still see business owners who are in my position that have a service-based business ask me what I think tariffs are going to do to them. Well, nothing. You do services, unless all of your clients are, manufacturers, but they're probably not, because this is a service-based economy.
Right. And so are you seeing any kind of recurring red flags that are maybe killing transactions from any of your clients or any of those?
The biggest red flags that I see kill transactions are not necessarily changing. I don't know that they're any different this year than they were last year, but there's a couple of things that will kill transaction. One is business owners who don't really know what their books are. In other words, we Alex will talk about this a lot, like recast EBITDA. If you got to pull out all these things that are lifestyle expenses in your business that aren't really, representative of what it costs to run the business, or aren't really representative of the profit of the business. If you have some guy who's paying his wife a salary of $75,000 a year to be a stay-at-home wife, but he's doing it for some weird bookkeeping reason, that's gonna, maybe that can hurt a deal. Because if I come in as a buyer and I go, wait a second, these payroll numbers don't make sense, even though they don't make sense to the negative. So once we correct them, the numbers are going to look better. All of a sudden, I'm a little touchy about things. It's like when I go to look at a house that I'm interested in buying, and you tell me that you updated, that fixed the foundation last summer. Oh shoot, no, that was 5 years ago. All right, I'm a little bit like, I just don't want to be involved anymore, because it's hard for me to know what's real and what's not. So that's one. The other one is business owner. This is the most important. Business owners who don't know what they're going to do with their life after their business. So many of us, we have our sense of purpose, our social connection, our identity itself rooted in the business. And if I don't have a clear plan of what I'm going to do, a lot of times business owners will crawfish out of a deal at the 11th hour. And that is bad also for the business owner, because some of these guys, you need to be selling your business. Some of them, this is the best opportunity you're going to get to sell your business for in the next 10 years. And if you don't take it, you're now a slave to your business until your 80s or something like this. It's not necessarily going to go well. Or maybe you're not the right guy to lead that business to the next growth plateau that it's got to get to. And so you're going to try to maintain, and it's going to end up sliding. People, when they don't know, I think a lot of people underestimate the amount of internal work it takes to understand what I want to do with my life, where I want to get social connection, where I'm going to get purpose. People think I'm going to golf and I'm going to go to the beach and I'm going to travel and hang out with my grandkids. That is not going to work. And the reason it's not going to work is because, particularly as a business owner, you've spent your entire life creating. You're a maker and you're a doer. And you think you're going to go be a consumer, you're going to be a taker, and that's going to work for you. It's not. And the guys will see that. I say guys, men and women will see it when it's like right here in front of their face and go, oh, wait a second. I can't, that's not me. And they go, never mind.
Yeah. Yeah, no, that's definitely a recurring notion I've found on a lot of this series is those 2 points that you made. You know, knowing your finances, having your books in order, and running your business well. But that aspect of exiting your business and being prepared for it, that's yeah, I keep hearing that over and over. So that's definitely a noteworthy insight for sure. Let's talk deal types. Are you seeing any deal types that are particularly active right now?
I don't know if this represents, the broad swath of American business owners. In my world, I have noticed that it seems like there's a lot more business owners willing to pursue owner finance deals than I've seen in the past.
Hmm.
And I was thinking about this as you asked me, James, well, hey, when we were preparing for this conversation, what do you think's going to, what do you think's changing with deal types? I was like, well, why is that happening? And if I had to hypothesize it, I think that because interest rates have persisted at a high rate, you see this with home sales. In the beginning, 2022, rates come up. We're so used to the decade-long sugar high of low rates that we think it's just going to last forever. And so people said, I'm not going to buy that house that I really need, that I really want, that I even can't afford because rates are going to come down. I'll just wait for rates to come down. And we wait and we wait and we wait. And it's like, the reality now is hitting 3 years later of rates ain't coming down. If they do come down, they're not going back to what they were in 2019. So give up that dream. People go, oh man, well, okay. So what does that mean? Well, if that means now I'm looking around and I see fewer buyers also, right? Because the PE firms are a lot more discriminatory now. Well, I was willing 5 years ago, I was willing 6 years ago to owner finance at 8.5%. That seemed like a totally fine rate to me at that time. But I wouldn't do it because that's high risk. But maybe I'd do it at 8.5. Now somebody goes, well, if I go and try to owner finance for 10, 12, what would represent the increase in the risk-free rate of return, between these two time periods, nobody's taking that. My key employee, who's the most qualified person for me to own or finance, he's not going to do this deal at 12. So I'm still having to offer the same rate that I would have offered 5 years ago in a lower interest rate environment. And I just think that's interesting. I think that's probably what's happening. These guys look around and go, if I really want to get out of this thing, the best and quickest option for me is to owner finance. I'm a little bit more willing to take the risk, kind of because that's what I have to do, but I'm hurt myself because I'm not really able to get the rate that I should that represents the risk of owner financing. I hope I'm explaining that well.
I think so. I mean, I've heard that sentiment a little bit as well in this year where seller finance or some sort of equity rollover that's been really popular for the last few years from what I've been informed. And I think it is probably tied to the interest rate being so high, and capital is expensive. So it could be less expensive to just work a deal, and without the banks and such, and maybe that'll be a little bit more cost effective for all the parties involved. So,
and that's why deals are failing too, because that's an even harder thing for me to accept because I'm not looking down the barrel of a $10 million check, right? Like
yeah,
a $10 million check can get me, or whatever the number is, right? That can get me over my, I don't know what I'm going to do with my life, but
yeah,
oh wait, I'm just going to get the monthly.
yeah.
Yeah, man, now I'm reevaluating that a little bit harder. I do agree, though, that I would think the second most common thing that I'm seeing is the increase in equity roll-ups. But that's just a more specific type of buyer, than or seller, I guess.
So let's shift this a little bit. What is one piece of advice that you're giving clients more this quarter than you were last quarter?
That's a really good question. What piece of advice am I giving more frequently this quarter than last quarter? There's a lot of advice that I'd give every single quarter of the year, all year long. But I'd say
Yes.
this quarter, we just had, and this probably didn't affect the books of your business, but we just had in the stock market world a very good example of why examining short-term data is unhelpful. So in April, if you go check out the S&P 500. I mean, I'm sure you were following, right? You knew what happened with right after the Liberation Day tariff announcements. We had in April one of the 10 worst days in stock market history and one of the 10 best days in stock market history. Today, the market is better off than it was before the tariff announcements, yet tariffs are higher today than they were before the tariff announcements. It is illogical if I frame it that way, but that is what has happened.
Yeah.
So if you are following the day-to-day, the week-to-week, even the month-to-month on macroeconomic news, like you're going to drive yourself crazy and you're not going to really get a helpful sense of what's going on. So if you're making decisions for your business, asterisk with like specific circumstances, but if you're making long-term decisions for your business based on short-term news, I think you're really going to get hurt. And so we had a very, very good lesson earlier this quarter on why that's so problematic. You could make short-term decisions based on short-term news, but don't make long-term decisions based on short-term news.
Yeah, no, I like that. That's a good piece of advice for sure. And it kind of goes back to what we were talking about earlier, where people are reacting to things that don't really impact them, and it's short term, and it's just being compounded by news media and such. So no, yeah, I like that for sure. So okay, last question, and let's bring out the crystal ball. So if you had to bet on one shift in the transaction space that's coming, what would it be?
I think that you'll see, I hope, over the next 12 months, more willing buyers. So, like I said earlier, with people kind of trying to be patient and ride out the interest rate wave and say, oh, it's gonna drop. I'm not gonna look right now. I'm not gonna be interested in buying right now. I think people will kind of just get used to that this is how it's going to be. Like, I don't think you're going to see quantitative easing like we saw post '08. I hope we don't. I mean, that's not great long term, but it's not sustainable for us to return to that. So
Yeah.
when the reality sets in that that isn't coming back, then I think buyers will react. And we've got to recognize that, like, here in 2025, there's a lot of business owners who, I mean, I'm one of them, whose entire working years and entire conscious years, were an economic environment that is just so counter to the historical norm. But we don't understand that because that was our lived experience. So when people kind of realize, oh, there's a new kind of era that we're going into as far as fiscal policy is concerned in this country, there's a new era we're going into as far as economic concerns, then the M&A landscape is going to shift. So I think it will shift to, at least in the, compared to 22, 23, 24, I'm hoping there's an increase in more willing buyers who have maybe just been sitting around and realized they sat around for too long.
Yeah. Yeah, no, I hope so too. I hope so too. I share that same sentiment. And I think it's coming as well. A lot of folks I talk with are hoping something similar as well. So I definitely appreciate that.
I will add to that though, James, if you're a seller, I wouldn't tell you wait for that buy demand to increase. I think that's a very dangerous game. If all of the other signs in your life and your business are pointing to sell, you need to be moving toward that regardless, and don't try to time the market. You wouldn't try to time the market with a stock investment that you were going to make. Time the market with the biggest stock sale of your life, which is the sale of your primary business.
Yep. Yep. No, for sure. I like it. I like it. Sanger, I appreciate these insights, man. This is gold. For those of you that are watching, I hope you find this as useful as I do. For more insights from our Deal Pulse series, you can check us out on our social media pages on YouTube as well as LinkedIn, and learn more about the Vant Group at thevantgroup.com. Sanger, thank you for joining us.
Yeah, thanks for having me, James.